We're gonna start in a bit.
We're gonna start my lesson in about 5 minutes or so.
Okay.
Okay. And the dog down.
Hi, kisses. You're gonna yell at students?
No, this is a class. I have to set it up so that I can start lecturing. No, that's right. You know what? No. Also, I don't be wearing a Lucy somewhere.
That's a trick question.
Not this shirt. This is a little too wrestling practice. Alright. Oh man, we only got 2 people? Whew. This is kind of disappointing. Wait, 3. Okay, great. We got a few more people. I just want to wait a little bit longer so that, well, not lecturing just to 3 people who I'm guessing are some mixture of Cedric, Dawson, and, oh my god, I'm forgetting that third student. Oh man, who's really, really good about showing up. She's gonna be so mad at me. Oh. Hate it when I do this. Anybody get your stimulus check yet? No one got their stimulus check? I imagine it's going to be a few seconds behind. Alright, so, we'll wait a couple more minutes. People are slow to show up, which is understandable because everyone's at home. Just a few more. Teach to 3. Oh no! Weren't eligible. Ugh. Oh no. Well, that could be a good thing, right? I mean, there's 2 groups of people or one of the groups of people who are not eligible for the stimulus check are the folks who are extremely wealthy. Well, not even extreme, just rather wealthy. Who else isn't? Dependents? I don't know. Maybe a few others. Anyway, don't want to tell too much about my finances, but we're looking forward to a check. Yeah, it's hasn't been too bad on us, thankfully. All right, so we have enough people to start, I think. Just a few announcements. First one is I'm going to post the third test on Blackboard probably next Friday. You're going to have 5 days or so to complete it, and then after that, I'll post a cumulative final exam. Anyway, a little details about the exam. They're just going to be on Blackboard. It's going to be a lot like the attendance questions that I posted earlier in the year when we had our in-class tests. The tests will be completely open book, open note. You'll just have an hour to complete it, so you can use any material that you want. But you obviously can't take the test in a group, that sort of thing. It's going to be the honor code. Please don't cheat. It would be really disappointing to see that, especially because I'm giving you so many opportunities to do well on it. The other little housekeeping detail is that because of COVID-19, everyone is going to get full attendance points. So, I couldn't really take attendance for the remainder of the semester, so everyone's going to get full attendance credit. So that's basically the equivalent of a 100 on a test grade. So happy first year. I think that's it in terms of housekeeping. I'll send out an email with this material after we complete today's material. Luckily for you, this class might be a little bit short today, but we'll see how it goes. It might be a little bit long too. It's difficult to tell. Anyway, what we're going to do is we are going to apply what we've learned about fiscal and monetary policy in the context of the aggregate demand, aggregate supply model. What you should pick up on is a lot of the policy prescriptions that the Federal Reserve and the White House and Congress are doing right now are completely in line with the model we're going to be discussing today. So, they're making fairly predictable moves. Now, after we cover this, we have got at least 2 more chapters to cover. We're going to do one on financial panics, market panics, financial crises, and then some stuff on foreign exchange rates, foreign exchange markets. That's gonna be it. We might do some stuff on the type of economic policies that enhance economic growth and what they should be aimed at doing and how economic growth occurs. But honestly, given the crisis that we're in now, I really want to spend more time on basically what the administration, what the government's doing right now, and how we're trying to get out, or weather, I guess is the better word, weather the COVID-19 crisis and trying to prevent it from going into a full-blown depression. All right, so let's go ahead and get started. All right, so what we have here is a really slick graph that I've made that presents an economy that's in equilibrium. The blue line corresponds to the aggregate demand curve. It's downward sloping to the price level. And the green line corresponds to the short-run aggregate supply curve. And that's upward sloping, so aggregate supply is increasing in the price level. What I also have graphed is basically equilibrium lines, right? So right now we have an economy that is, the short-run equilibrium is the same thing as its long-run equilibrium. We're not in an inflationary gap. We're not in a recessionary gap. We have our natural rate of unemployment. We are in good shape. And so what this means is that our long-run output is just the same as our short-run output. So let's create some sort of demand shock, aggregate demand shock. All right, and some of these aggregate demand shocks, let's just say people become more optimistic about the future. So increase in optimism. If we have an increase in optimism, that is going to shift the aggregate demand curve up. So let's shift that aggregate demand curve up, and there we go. Now notice what's happened here. We still have our long-run equilibrium, which is our long-run output, which is a long-run output of 5, and a long-run price level that is also equal to 5. And that's indicated by these two lines, this one and this one. But now we are at some temporary equilibrium. And in this temporary equilibrium, the price level is 6 and output is 6. All right. So what we have here is a little bit of inflation, but also higher output. So we're in an inflationary gap. In this inflationary gap, there is too little unemployment. So now we have some options. How we can return back to our long-run aggregate supply curve, or either get rid of some of this excess unemployment, or this excess employment. Sorry, I misspoke. Excess employment. There are two ways we can do this. The first way is the way that would be favored by the classical. So let's do the classical solution. The classical solution would be to do nothing. If we do nothing, that means basically what we're saying is we are going to let nominal prices adjust. And if we do this, things like wage rates are going to increase. So wages increase. And that is going to cause this short-run aggregate supply curve to shift up back to the long-run equilibrium. And there we go. So what you notice here, oh, what is that? Thought it was a co-author. What you'll notice here is that we return to our long-run output, but we also have a bit higher price level. All right, so our price level, in our prior long-run equilibrium was at about 5, and now it's increased to 7, which, it's one of the problems of the classical solution. You see a little bit of more variability in the price level. And so this is one of the benefits of the Keynesian model, the Keynesian paradigm, or the interventionist model. That is, that we can prevent these changes in the price level. So let's go back to our original temporary equilibrium, which is right here. Now we want to return to this long run aggregate supply curve, the thick black vertical line. And what we can do is just have the government, so interventionist approach, interventionist solution would be to raise taxes and or decrease government spending. And these are the fiscal tools. The monetarists, the people that support using monetary policy to shift aggregate demand, these guys are interventionists as well. They want to pursue policies that will increase the interest rate. Or, in other words, decrease the money supply. The question is, how would they do that? Well, the first way would be increase the reserve requirement. The second way would be to increase the discount rate. And the final way would be to use open market operations. All right, so now I'm going to pose a question to you. If we use open market operations to shift the AD curve back to the long run equilibrium, what should we do? Buy or sell bonds. I'll give you a few moments to answer this question. So we got one answer, and this would be to sell bonds. And that is actually the correct answer. Good job, Anthony. What we want to do is we want to sell bonds, because if the Federal Reserve sells bonds, well, then they are giving out the bonds and they're taking money from the banks, which shrinks the money supply. So doing both of those are going to shift that aggregate demand curve back down. And then we return to a long-run equilibrium. All right, the same thing would work. So let's return to that. Return to that previous off equilibrium. We could do the same thing with fiscal policy. You know, we could raise taxes, decrease government spending, and both of that would destimulate aggregate demand. In other words, in both these cases, when we are in an inflationary gap, we are going to use some type of contractionary policy or some mixture. Oh, good question, Anthony. Government. The government is going to sell bonds. The Federal Reserve in particular. Great question. But returning now to the main point, we could use any one of these solutions or some mixture of them. All right, so we've dealt with a negative demand shock. Now let's try a different type of aggregate demand shock. We'll say people in poorer country or people in other countries, foreign nations. Man, my spelling is awful. Foreign income falls. All right, so if foreign income falls, this is going to be a negative shock to the aggregate demand curve. So let's do -2. Shifts our aggregate demand curve down. And then what you end up seeing is that we have this temporary equilibrium that has a lower price level and lower output. In other words, we are in a recessionary gap. All right, during recessionary gaps, we are producing within the long-run aggregate supply curve, meaning that we're not producing our long-run level of output, which means we have too much unemployment. So we have two ways out of this. We can take the classical solution, which will, argue that the market will adjust on its own, or we can use some of our interventionist tools. Now, the classical solution here is just let prices adjust, right? So when we say let prices adjust, well, right now we have too much unemployment, so employers can start offering lower wages, which are going to pull people into the labor market. People are going to be more willing to accept those lower wages because there's just so much unemployment in this case. And because wages have fallen, well, that makes it cheaper for producers to produce. So we can have this short-run aggregate supply curve shift down and back to the original level of output. Now, notice, again, using this classical solution, we get a very different price level relative to our original equilibrium. So our price level falls after a negative aggregate demand shock and using the classical solution to return us back to our long-run level of output. Now, how fast does this result happen, and does it happen? I would say people are becoming a little bit more savvy to this. To give you a little bit of a personal story, which I don't know if it's 100% appropriate, or if my wife would appreciate it, but she just took a little bit of a pay cut, and part of the reason is, to stay afloat during this recession. That means they're going to have to cut wages some because the businesses aren't producing as much, and because they're not producing as much, revenues aren't as high, and so they got to cut costs somewhere. Moreover, there's going to be some competition going on, right? So last I checked, 22 million people filed for unemployment claims. That is insane. That is a huge number. And, we would expect wages to be lowered, to fall in this sort of situation, just because, there's so many people out there looking for jobs. And, it's just happening. All right, so this is the classical solution. The drawback of the classical solution is that, you have variability in the price level, which can cause issues. And the second problem is we don't know how long it takes. In this case, in the case of COVID-19, I would argue the self-adjustment mechanism has worked relatively quickly. All right, so let's move back to our interventionist approach. And so here we're back in our recessionary gap. And what we want to do is we want to use one of our interventionist tools. All right, so for our interventionist tools, in terms of fiscal policy, what would we want to do? Well, we want to stimulate aggregate demand, so this would be increased government spending. Or two, decrease taxes, and or two, decrease taxes. Both of those should stimulate aggregate demand to some extent. And this right here is exactly what's going on with those stimulus checks. What the government's trying to do, it's trying to stimulate aggregate demand, trying to get people to not completely hoard their cash and get spending back up. All right, so let's shift that aggregate demand curve back down to where it was in our temporary bad equilibrium. And let's do the same thing, but with monetary policy. So how can we stimulate aggregate demand using monetary policy? Well, the goal is we have to figure out some way to decrease the interest rate, thereby increasing investment. All right, so there's a few ways we could do. All right, we could buy bonds, particularly the Federal Reserve could buy bonds. And if the Federal Reserve buys bonds, what they're doing, they're buying an illiquid asset from banks, and then they're giving them cash, which the banks can use to make loans, which will lead to decreases in the interest rate and spur on investment and consumption. It's basically increasing the money supply. All right, so now what I want you to do is tell me what the Fed should do. And I'm going to put this in quotations because one of them is a tool that's hardly ever used to decrease the interest rate, but not use using open market operations. So tell me what the Fed should do. Other than buy bonds. We'll just give you a few moments to answer the question just because we have these silly lags. Nothing? All right, well, this one is a little bit tricky because we tend to focus on open market operations, but the Federal Reserve could reduce the reserve requirement, which would increase the money supply through changes in the money multiplier. So remember that the simple money multiplier is 1 over the reserve requirement. So if the reserve requirement gets smaller, well then that multiplier is going to get bigger. So our money supply is going to increase. The other thing that they could do is reduce the discount rate. Reducing the discount rate would encourage banks to borrow, make loans out on that money, all of which would shift the aggregate demand curve back up to our long-run equilibrium. There we go. Now, here are some issues, though, that worry a lot of economists, particularly with in the long run as it pertains to COVID-19. One of the problems is that we're beginning to see businesses shut down. And what this means is that our short-run aggregate supply curve is actually shifting up. So we're getting kind of in this position. Now, when this happens, we're in a kind of a deep pickle, because the only real way out of it, at least using the interventionist approach, well, using any approach really, is going to result in inflation. So right now, you'll notice that we are in a recessionary gap that was caused by a backwards or upward shift in the short-run aggregate supply curve, meaning like firms are going out of business. There's been a increase in the cost of inputs. It's harder to source inputs. I mean, this should really sound familiar from what you're hearing on the news. What we could be dealing with is a supply shock. And those supply shocks those negative supply shocks in particular, result in recessionary gaps as well. But it's a recessionary gap that has inflation. Price levels start to increase. Now, the way out of this using an interventionist approach is still the same old, shifting that aggregate demand curve back up through increases in government spending and decreases in taxes, and also the monetary policy solutions. But doing so is going to cause inflation. So these interventionist approaches during times of a shift in the short-run aggregate, a shift in the supply curve or a supply shock, can possibly lead to inflation. And that is one of the primary criticisms of the government's policy right now. You have a lot of economists that are worried about, inflation happening. And, it's something that's it's in the back of my mind too, as, a typical middle-class guy who has, good savings. I don't want to see the value of that savings just be destroyed because the government starts printing money. At the same time, we were worried about the same sort of inflation thing happening during the 2008 financial crisis, because you had this huge financial crisis, and the government just started printing money like crazy, and you would think inflation would happen, but if you look in the time period from 2008 to the present time, even under President Trump, who has just done all sorts of inflation encouraging policies, we haven't actually seen inflation in the U.S. It's been relatively flat. So, maybe this isn't maybe concerns for inflation are overblown. To tell you the truth, I don't know what's gonna happen. it might falsify these models that you're learning about right now. All right, or the extent through which inflation is a problem. All right, so let's just return back to our long-run equilibrium. And let's also talk about how our self-adjustment mechanisms and not our self-adjustment mechanisms, sorry, the automatic stabilizers could work. So does anybody remember what automatic stabilizers are? All right, so Anthony just asked a question. Do you think that the economy was in a good spot and it saved the country from being even worse? That is a very tough question. I think the economy was in a good spot in some respects, but in others not so much. We had very low unemployment, which means that households should presumably have more income and therefore more savings so they could weather the storm. The issue is that a lot of the growth policies that were I don't know, put into place under the Trump administration, well, they resulted in even further increases in debt. So the idea behind a lot of these Keynesian solutions is that when there are good times, you want to smoothen that business cycle, maybe soften growth a little bit so that during the bad times you can buy your way out of trouble. And the issue is that, well, during the good times under the Trump administration, they sort of did the opposite, right? They reduced taxes, and when you adjust for changes in the population, the increases in tax revenue were actually relatively small, and they certainly didn't pay for all of the increases in government spending. So, are we in a better or worse place? I don't know. In some ways, we were probably in a little bit of a better place because consumers, households, they had more savings available to them because more people were working, so they can better weather the storm. On the other hand, we're going to see larger and larger amounts of the tax revenue generated each year going towards paying for the debt that's been accrued. So basically the government's going to have to pay interest rates. It's going to have to, a larger and larger share of the national income, tax revenue is going to have to go towards paying for interest payments. So I don't know. There's good and bad to it. So I don't want to have to punt on it, but that's what I'm going to have to do. All right, Dawson asks, aren't automatic stabilizers features of economic policy that adjust on their own in response to fluctuations in the economy? Dawson, that is almost exactly right. The only thing that I would change is that they're not necessarily features, but there are laws that adjust fiscal policy automatically. And in the direction policymakers, interventionist policymakers, So Dawson, you were fundamentally correct, but your wording was just a tiny bit off from what I would prefer. All right, so automatic stabilizers, they're basically laws that are written in, that are already written in that engage in contractionary or expansionary fiscal policy in the opposite direction of the aggregate demand shock. In other words, they are laws that automatically cause counter-cyclical fiscal policy. Let's see if my spelling is good. Ah, it was okay. All right, so examples of laws that, they're counter-cyclical fiscal policy are, well, let's draw one of these graphs. Let's have our aggregate demand shift up. We have an aggregate demand shock. Well, what's going to happen during this time period? Well, we are going to see an increase in the tax rate, the average tax rate. And that's because the U.S. uses a marginal tax system. And during this, positive aggregate demand shock, incomes are going to rise. The probability that your income moves into a higher tax bracket increases. That means your average tax rate is going to increase. Hey, that's an increase in taxes. That is a great example of contractionary fiscal policy right there. Another thing that's going to happen during this positive aggregate demand shock is that government spending is going to decrease. And it's going to decrease through decreases in unemployment claims. All right, so there is less unemployment, fewer people are claiming unemployment. That is going to be a decrease in government spending. So we have these laws that automatically are moving us back towards our long-run equilibrium. All right, so let's try the opposite one. Let's have a negative aggregate demand shock. Bam. All right, so in this case, our price level falls and our output is below our long-run equilibrium. And, well, this is going to certainly cause some problems. But again, we're going to have laws that are already written in that are going to smoothen out this recessionary gap. And in this case, the government's going to automatically do two things. First of all, our average tax rates are going to fall. And this is because as consumer income falls, as household income falls, well, that means they are going to be more likely to fall into a lower tax bracket, and that means their average tax rate is going to fall. All right, so that is a decrease in taxes. That is expansionary fiscal policy. It's a great example of it. The next thing that could possibly happen is that unemployment claims are going to increase. Notice that in this case we are in a recessionary gap, so we have too much unemployment, and so unemployment claims are going to increase, and that is going to be an increase in government spending, and both of those policies are expansionary fiscal policy and are going to move us in the direction back to our long-run equilibrium. All right, so how do we feel on applying fiscal and monetary policy in the aggregate demand, aggregate supply curve framework? And what I mean by feeling comfortable, understand one, the shifters. Two, the classical approach. Three, the interventionist approach. So these are the things that you want to think about. So when we're talking about shifters, I mean those events that can cause shifts in the aggregate demand curve, as well as shifts in the short run aggregate supply curve. That's what I mean by shifters. On two, for the classical approach, I think you should have a good idea of how the classicals would argue that the economy would return back to the long run equilibrium. Three is the interventionist approach. So, what type of policies the interventionists would favor, and I don't know how they would go about intervening, using both fiscal policy and using monetary policy. You also want to consider how these two policies could, cancel each other out, right? So if the Fed engages in expansionary monetary policy and the government, the federal government, engages in contractionary fiscal policy, well, then you can have the two effects, the two things cancel each other out. So you want to think about that. The other thing, would you guys like to have this graph that you can play around with the shifts? I mean, I don't want to cause confusion, and because there are ways to break this graph, and I don't want people to break it and think that I steered them in the wrong direction. But I do think this is a nice little tool, right? You can play around with these shifts, and then you could write out some cases, whether this case creates an inflationary gap or a recessionary gap, that sort of thing. Just move the graph around, see how these curves work. If you want to use it, okay, cool. Well, then I will post the graph then. Just be sure not to break it, and if you have questions about, say you get something weird happening, get back to me, and maybe I can explain it. One thing, I've also added a long-run aggregate supply curve shift, and so we're going to briefly cover how the long-run aggregate supply curve can shift. Let's say, it shifts out in this direction, what that means, and how do we get this new long-run equilibrium. We're going to cover that. That's going to be in the chapter of economic growth. I don't know how much detail we're going to go into, but this is sort of the goal of long-run supply-siders, long-run thinkers, is that they want to keep shifting this long-run aggregate supply curve out. And so you can play around with this here, see how it shifts out, and, what we would expect to happen. We would expect this aggregate demand curve to shift out as well. So anyway, cool little toy you can play around with. I'll have everything set up at 0. Do we have any questions? I'll give you a few moments while I save this, and then you can just ask questions and I'll be happy to answer them. Save as, browse. desktop. We're going to do macroeconomics. All right, and we'll call this toy ADAS graph. All right, so I will load this up. I'm not going to go fiddling around with my email and loading up stuff right now. So you are free to go if you want. But if you want to ask a question, I will answer questions for the next 5 or so minutes. Okay, that's it. Free to go. Have a great afternoon, and I really enjoyed the participation today. Oh, yeah, I'll make a study guide. Yeah, I'll make a study guide. Keep in mind though, I'll make it really flexible for you. All right. So no other questions. No other questions. Have a great afternoon. I'm gonna just hang out here for a little bit longer. For till 11:25. Then I'm gonna cut the stream. But I will be around. All right. Graph. Serial. looks like I'm gonna end it. Bye.